the extent of the volatility over the last several years. It was a period of surviving is winning. I think we've survived and we're coming out on the other side a lot stronger and healthier than we were, certainly going in.
Welcome to Tank Talks, a podcast that brings you insights and stories from some of the best and brightest minds in technology and investing. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On this week's episode, we welcome back to the tank for the second time Dan Park, CEO of Clutch, to discuss how his team was able to navigate the recent downturn in the startup world and all the lessons he learned from that experience. Since his last visit in October 2021, Dan and his team have had to navigate some significant economic turbulence in the tech and automotive ecosystem. After securing a $100 million Series B and $150 million in debt financing, they also faced the tough decisions of including a 30% RIF. Dan walks us through those pivotal moments and shares the strategies that Clutch had to employ to adapt its business model and maintain trust with its customers and employees. Finally, Dan also offers insights on managing investor expectations during turbulent times and how the company is positioned today while hitting record growth. But before we jump into this week's interview, we welcome back to the tank John Ruffolo to discuss the news and stories making headlines in the tech and venture capital ecosystem. Welcome back to the tank, John. How you been?
I've been great, Matt. Thank you.
Our audience missed you, John, but they definitely didn't miss all the stories going around in the AI universe. Let's kick things off with something that happened actually a couple of weeks ago that we forgot to discuss, which was the Canadian head of Microsoft, Chris Berry, was speaking at an AI summit in Toronto, talking about how obviously Microsoft's AI service and Copilot are incredible ways to get Canada out of its productivity losses at the end of 2023. But the example that he gave, which was quite interesting, was how he used Microsoft AI's Copilot to write a letter of interest for a nonprofit board position that he was applying for. I thought that was absolutely hilarious. But I think the question really that the audience would love to ask you is, do you think AI technology can solve a lot of the productivity losses that we are seeing in this country? And do you even think enterprises are willing to adopt it at the pace they need to make up for the shortfalls that they are seeing in productivity?
When you ask a specific question on how do you improve productivity, right? There's only two ways. You either increase the numerator, which is increasing the value of the goods or services that you are producing, which is currently very, very difficult to do based on AI, or you deal with the denominator, which is decreasing or replacing the human labor with machine labor. I would say to you, most folks are focused in on the denominator. The question that I would have is, assuming that's the case, how many applications is AI today currently replacing on an effective basis? And I would say to you, not very many, not just yet. So conceptually, over the long term, you would think that the answer is going to be yes, it would help with productivity. But to suggest that's going to happen in the next near term, 12 months or so, I think is extremely optimistic, number one. And number two, I suspect that comment was made by somebody who would love to procure their services to the various levels of government, which foreign-based multinationals are quite known to do quite effectively. So,
yeah, he obviously was lobbying for his own services, of course. But I do see a lot of it happening already. At our stage of investing, we have seen a lot of enterprise software tools being applied to government inefficiencies and trying to solve a lot of the, broken telephone, if you will, in government, solving some of these mundane tasks to increase productivity, whether it's drafting emails, data analysis, automating routine business processes. Those things are being done today. In his example, there's companies that were mentioned like Canadian Tire or Ontario Power Generation trying to use AI applications to enhance customer service, which we all know is terrible, and matching energy demand with supply. Very simple, tactical things that can be done today. So I hope that even though there is obviously an economic benefit to Microsoft's head of Canada saying these things, it shouldn't really discount the actual value that can be done today for constituents and society as a whole.
I'm just a little bit more cynical where the Canadian civil service has increased over 40% in the last 3 years. And you kind of wonder, I'm not sure I see very many productivity gains on that, because in theory, and people are correlating to the rise of our population, but that's bullshit. if you are accepting the notion that if it's a machine that's replacing human labor, it should be scaling in theory indefinitely.
Yeah, continuing to add more and more jobs to the public sector. I don't understand it, nor do I see how there is even a budget to pay for some of these when we're out of money as we stand today. Switching gears a little bit, the IP rights regarding AI and training always seem to, pop up in the news every week. But, one of your favorite universities in Canada, University of Waterloo, and the researchers there were actually quoted and caught up in a little bit of an intellectual property violation, where they were using some of the data that they'd scraped from, educational sites like Chegg and Khan Academy without permission to, try and enhance their AI reasoning capabilities. And these issues continue to arise around how some of these education platforms who are strictly told to not data scrape, are still using it. And I think it's just a sign of how slow regulation is to catch up to the speed and the rush to advance AI technologies when they really just don't have the tools to watch and set up the guardrails for this. Did you see this in the news the other day?
I did. And this is still the really big elephant in the room on the patent infringement. We're seeing it more visibly in the creative sector. So you've seen the book authors led by Margaret Atwood. You're seeing the musicians, et cetera, that are basically saying, hey guys, I don't know where you're scraping this data from because we haven't given you any sort of permission. And it's sort of being swept under the rug. But I think this is one of the biggest issues that still need to be solved. Where are you getting your data from? And we are starting to see, I think, Reddit's agreement where they made the deal to scrape their data. What's going to happen ultimately if people are abiding by the appropriate intellectual property and data laws? You're going to see a lot of the dollars being spread far more greatly. And I wonder what that will do with the economics that a lot of venture capitalists have put into a lot of these AI application programs, and wondering what will the unit economics ultimately look like?
Well, yeah, I mean, for the incumbents, they have a lot of the data that they're already generating internally, obviously with Google and Meta and Amazon and even Apple being able to do that. But for some of the up-and-comers, they have to purchase this data or they have to subscribe to it. I listened to Sam Altman on the All In podcast the other day, and he had a really thoughtful framework of how he's thinking about using and leveraging third-party data. They're in negotiations or they're announcing, a Times, data permission. The New York Times, obviously people question whether or not Sam Altman is trying to create some type of regulatory framework so that they can benefit from regulatory capture. But it didn't really seem like he's oblivious to obviously some part of guardrails and permission structures that need to be put in place so that there aren't these sort of legal battles and ethical battles going on between content creators and AI, frontier model builders. So I don't think it's going away, but it's definitely still percolating a lot more. And now seeing University of Waterloo caught up a little bit in this with their researchers, I guess shouldn't come as much of a surprise. But what did come up as a bit of a surprise was the downfall of Stability AI, which is known as the AI image generator of Stable Diffusion. I guess we should have known, given when Sora came out from OpenAI, all of these image generation tools were probably going to have a really tough time in building a business. But let's not forget, Stability AI reached $1 billion valuation in 2022. They were funded by Coatue and Lightspeed, and they'd raised over $100 million, but obviously struggled to get to profitability with higher cost and competition from other AI firms. Now they're exploring a potential sale, but the revenues were just so short of what I thought. 1.5 million in 2022, 8 million last year, and they lost over 30 million in the first quarter of 2024, and they owe nearly $100 million. So I think, the CEO resigning early in the year among controversies over mismanagement and exaggerated professional credentials, it seems like the firm's future is hinging on finding a potential buyer, which I don't even know how they're going to do it.
I think this, actually, it was funny. I was just mentioning this as an example today to some other folks and looking at, again, we're in phase one of the whole Gen AI platform. We're at the infrastructure layer. And if Matt, if you and I are right, and we believe there's only going to be, a rule of 3 or 4 major players, and yet so many of them have been funded, that does suggest that many will go away. And then the question is, if they go away, what residual value do these things have? This will be a good test case of not a whole lot other than perhaps the captive workforce, but the demand for these individuals are so great that they can get a job anywhere. So what is really left over, aside from very significant potential losses? And again, that's okay. That's the venture game. But have people been a little bit too loose with their investment strategies? And I think it's going to start to not create a chill, but making people a lot more cautious on how they're throwing money into the whole Gen AI space.
Yeah, I mean, we saw this obviously too the other day with Apple's potential announcement with either OpenAI or another frontier model provider, similar to the deal they have with Google as their search provider, which is a $2 billion transfer of cash every year to their bottom line. It feels like network effect, distribution channels are still their defensible moat as the incumbents, that no matter what money gets poured into these models, and now open source models being available for free, it's going to be a really hard game to make money at, no matter how much you push in the beginning. And so did you have any thoughts around that Apple news around how they're going to potentially let, OpenAI or ChatGPT, which is already available on the iPhone, but maybe embed it directly into Siri, is going to play out?
I think Apple is looking at the picks and shovels game. Don't pick the winner, and just what you just said, play the role of being the distribution channel in their walled garden. And, despite the fact that their walled gardens, coming under attack as well for its monopolistic behaviors. But I am not surprised to see this. The Llama announcements from Facebook in particular are interesting. What happens if that becomes the standard, in which case it really becomes a Linux model and there's really no money to be made on the infrastructure front, but rather for all of the services or the app store around all of that? And again, Matt, you and I had talked about, where do we think the money is ultimately going to be? At the application layer. And it feels like that's where Apple thinks the real money is going to be. And that's where they're extremely strong.
Well, just play back history, right? So Apple doesn't really make apps, right? They are an app store, and they take 30% VIG on whatever apps are sold or subscriptions, which is toll charge, which they've gotten in trouble with, obviously, with the Epic Games battle and stuff. But I think what you're saying is, stick to what they're really great at, is building incredible hardware matched with incredible software, and then let some of the other infrastructure that you're going to look at, almost like a chip provider or a screen provider, embed that into the product, but then let the applications continue to build on top of it. One interesting application that our team has been playing around with is this new app that is a localized model that you can download as an app from the App Store. It's a 500 megabyte OpenAI powered Model 4, maybe 3.5, that runs locally on your hardware device, not connected to the cloud, and can act as its own AI agent trained on your own personal data, but not leaving your device going up to the cloud. And I think that's where we're heading, is everyone has their own personal model running on their device that doesn't connect and allows you to answer questions or whatever task you need, but really has a high privacy, which is what enterprises probably care about a lot as well. So we're testing it out. It's pretty cool.
And Matt, just kind of reinforcing your point, with the latest release of the GPT 4.0, it's out Siriing Siri, on the personal assistant front. So you're absolutely right. That's the direction that I think is an interesting battle.
It's moving really fast to that direction.
Moving really fast. It surprised me how fast. And again, I watched the video demos, but I was impressed. This takes Siri to another absolute level.
I have a fear that our kids will not learn. Well, forget cursive writing. It's just math. I mean, they don't even need to have to learn how to do math. They just need to learn how to talk to her. It was definitely a her moment demo that they provided. All right, switching gears here, John. The last thing to cover is the office vacancies in downtown Toronto. I go down there several times a week. You're down there recording this right now, but man, the situation is exacerbating. It feels like major offices are under significant stress. And the concern right now is the threat that it's going to provide to property valuations, as the market is deeply divided right now between fully occupied buildings and others that are grappling with significant empty spaces, some up to 50%. Obviously, the Well is a massive, new development that is also trying to entice people to come back to office and work. And, with a mixture of high interest rates, slowing economy, shifting in tenant preferences towards newer and more modern amenities in their buildings, what are you seeing out there? And what do you think will happen here as these potential buildings get revalued?
There's a clear stratification on A, B, and C buildings. So the A buildings are the ones that are largely getting filled to some level of capacity, but really about 70% of pre-COVID levels. But you saw in that article in the Globe, the B's and the C's are really struggling. And then there's a divide on the A buildings between old and new as well. I had first thought that post-COVID, it would take about 5 years or so to absorb the excess inventory. And the problem is, when I speak to a number of the leasing brokers, there is a lot more capacity coming online as folks that have captive spaces and they're starting to mature are decreasing their space requirements. And that hasn't even come out on the market yet. I don't see this turnaround. I thought it was 5 years. Is it 10? Is it longer? But the one question that people keep on always saying is it an opportunity to rezone it for a lot of them for residential or combined use, which could be the real interesting way to solve some of these problems.
Yeah, the mixed use solution is definitely something that is continuing to pop up. Downtown Toronto, as of late April, stood at around 17%, which is quite high across national figures. The other thing that I think people need to consider is the implications of these rising vacancies across the financial health ecosystem. You're talking Canada's largest pension funds, who are mostly the landlord owners at the end of the day of some of these big, vibrant downtown buildings. And so it actually impacts a lot of Canadians, not just the actual landlords or maybe some of the larger investors, right?
So this is an interesting point, and actually one that I was very concerned about. If you look, I'm going to overly summarize it, from about 2011 to about 2020, all of the large commercial owners in Canada were reporting low double-digit gains year after year on their real estate. But it was split. Half of it was approximately cash-on-cash returns, and the other half was on the cap rate compression, which elevates the valuation of these buildings. And my concern was, at some point in time, it was compressing the cap rates, which is the way that they get valued, by virtue of decreasing interest rates. But I kept on saying, what happens when it reverses? Well, in that same example, are we going to run into the next decade where the gains reverse and it's offset with the cash-on-cash returns, and then they end up with a net zero return for the next 10 years? What I did not anticipate is the cash-on-cash return was predicated on a 2-ish% vacancy rate. Now we're approaching 20%. So you can see negatives for a long while. And you're seeing in the United States, transactions are occurring where the people are just handing over the keys. It hasn't happened yet here, only because we have a concentration of very, very deep capital pools. But watch very closely on the B and C buildings, and watch on some of the multi-res that are owned by smaller landlords where they don't have the financial flexibility.
Yeah, it's not pretty. I mean, everyone saw that, building in the States that transacted for, I don't know what it was, like 20 million or something. And that wasn't just assuming the debt. That was actually the value of the entire asset. So it's a pretty grim time out there for some of these smaller landlords, as you put it. So we'll wait and see what happens. But hey, we didn't talk about capital gains this time. So we'll save that for the next one. Thanks for jumping in the tank today, John.
All right. See you, Matt.
Now let's jump into the tank for this week's episode with Dan Park from Clutch. Thanks for joining us in the tank today, Dan, for the second time.
Thanks for having me, Matt.
Since we last had you on the podcast back in October 2021, it's been a crazy ride for you and the team at Clutch, to say the least, but probably not uncommon among many rocket ship startups out there over the last few years. So to kick things off, it'd be great if you can give our listeners a bit of a background on you and your company in case they missed our first podcast and learn about your journey as starting as the CEO of Clutch in 2019.
Yeah, so we are Canada's largest marketplace for used vehicles. We buy cars from the general public using a machine learning-based pricing model where consumers can come to our website and get an instant cash offer for their vehicles. We then take those vehicles and we process them through a vertically integrated facility where we do a 210-point inspection, we photograph the car, we detail the car, we do any mechanical upgrades to the vehicle, and then we list them on our website where people can buy seamlessly using an online experience where we deliver the car or customers can come pick those up. It's been a crazy ride since we last chatted. I don't think anyone really anticipated the extent of the volatility over the last several years. Happy to go through some of that, but it's I think we're firmly on the other side of that now. At least it was a period of surviving is winning. I think we've survived and we're coming out on the other side a lot stronger and healthier than we were, certainly going in.
A lot of founders and a lot of listeners obviously hear about the headlines, but they don't understand obviously the decisions and the impacts and, whether their company is weathering a storm as well. It's so great to have founders like you willing to share the story, CEOs like you willing to share your insights so that they can maybe be better prepared when they enter in some volatile times like you did. So since our last podcast, your company went on to raise significant capital, $100 million Series B in November 2021. And then obviously because you're purchasing a lot of inventory, holding onto it and then reselling it, you raised $150 million in debt financing from Neuberger Berman in May of 2022, I believe, which was a secured debt facility against obviously your inventory rather than an operating capital line. Following that financing, the company had to make obviously some tough decisions to lay off approximately 30% in order to stay competitive. And you were quoted as saying that we're not immune to what's going on, obviously, in the tech company around the world. So can you kind of walk our listeners through those financing rounds and how tumultuous it was for you as a team during that 2021, 2022 peak ZIRP days? And how you were influenced by Sequoia Capital's Crucible Moment memo when deciding in what direction to take Clutch?
When we chatted, we were just on the cusp of raising our Series B. I think that round took maybe 30 days to put together. We had 5-6 term sheets, and frankly, we had valuations 20, 30, 40% higher than the one we ended up taking. Again, this was a time where capital was obviously super cheap and companies were scaling. And that formula for the last decade plus was the formula, right? You scale the business as fast as you possibly can, you generate user base, you win market share, and then you fix the foundations after you're at scale, right? That's what my background. I was at Uber. That was the formula, and that formula worked. And then all of a sudden, early 2022 starts rolling around, and you start seeing some signs of cracking. I went to New York early 2022 and started meeting with investors. And at that point, you could tell the sentiment was starting to shift. Markets started softening. Some of the larger public companies, their stock prices were falling dramatically. Certainly our biggest comp was. Coming back from that trip, really in April of 2022, the writing was on the wall. And I think at that point, Sequoia had just come out with that deck. My philosophy around startups generally is your speed of iteration is what's going to differentiate you from winning and losing. And, at that time, we thought we cut pretty deep, and we were one of the earlier companies to cut really deep. I think when we cut, there was a huge 2-page article in BetaKit around, our layoff, which I was like, okay, that's interesting news. But I think that you're going to start seeing more of that. And lo and behold, we went through a period of, startups shutting down, layoffs happening. I think even this quarter, Q1 of this year, you're still seeing some of the highest number of startups still shutting down and layoffs still, above, frankly, pandemic levels. And so you're still seeing some of that starting to work itself out. But back in 2022, our philosophy was, let's get the business right-sized as quickly as possible and then start looking for additional capital. We put some pretty hard deadlines on ourselves to raise that additional capital, and we actually secured a term sheet and started working towards a $95 million Series C financing in December of 2022. I don't think a lot of this, this is probably news to you and news to a lot of folks and your listeners for sure. Probably within 2 to 3 weeks of closing the round, our lead investor called us and said, you know what, sorry, not feeling this deal. And then we had to resort to plan B. Plan B was a pretty dramatic shutdown of our Western Canadian operations. That's when we really went into survival equals winning and focused on getting the business to profitability, on unit economics, a lot of the foundations that a lot of companies, back in the ZERP days would do after they were, and we were at decent scale, but after they were at significant scale. And I think the market just forced us to do that a lot earlier. And then shortly thereafter, Silicon Valley Bank, goes through their thing back in March. And, it feels like chaos. I was around in 2008. I was literally working on Wall Street. My office was on Wall Street, and I was sitting on the desk, the leveraged finance desk of one of the major banks, and the head of leveraged finance came in on, I think it was like an April afternoon, and was like, "Hey, there's no more credit." And then shortly thereafter, the Lehman Brothers goes under, Bear goes under, and kind of chaos ensues. It felt like that again. It felt like SVB is going under. There's chaos again. People are getting, startups are being, again, this is very much isolated, I think, to the tech sector, but it was, I think, it was a very dark time for me, certainly, and it was a dark time for, I think, a lot of other startup founders. But ultimately, we just put our heads down, focused on our core markets, and a year and a half later, not less than a year and a half later, year and a bit later, the market still feels like it's recovering, and our business specifically is in a really great spot now.
First of all, I appreciate you sharing all that detail. I think a lot of people may have taken some headlines and just extrapolated their own thoughts and came to their own conclusions. But, it's really important for people to listen to what you're saying, because just like you, I was also working in New York on Wall Street during the crisis. And what I learned from that time, just like you did, was everything is interconnected. And as soon as one crack opens up, everything else starts to fall down over time, but all things do fall in the same direction, like a domino. And what you saw was, as soon as you had that obviously big Series B round that was closed in November 2021, you went back to test the market in Q1 of 2022, and the conversation started to change. It was like, hey, congrats on the progress, great success, just a little bit too early for us, or just not the right time for us to be deploying capital at this stage, but let's keep in touch. And that was a quick change for you in the sentiment that you were feeling. And so when you came back, you made those cuts, and people were like, wait a second, they just raised capital and now they're cutting staff. That makes no sense to me. But you obviously had firsthand experience with this back in the day. And now seeing the sentiment change, you knew that the first ones to act were the ones who end up probably having more options available if things got really bad. And sure enough, they did when the Series C fell apart at the very end, which again, not uncommon probably during the end of 2022, but it still sucks when it happens to you. Maybe talk about the strategies that you were employing to manage your team, your culture, reducing the geographic and team size, footprint in order to become a better leader to see through the other side of that crucible moment.
The first was just the speed. I spoke to, a few other investors and some of our legal counsel. They're like, 2 weeks before closing, that's not even that bad. Like folks are pulling out on the day of wiring. Like, you should feel good about that. At least they give you a couple of days, a couple of weeks heads up. And so very common, and probably more common than people appreciate. I think that feeling of not being alone helped me get through a lot of this. I think if it was just our company that was going through this, I'd feel like, I'm certainly doing something wrong here. This was a market-wide phenomenon that affected a lot of companies. And so, from a team perspective, I think everyone understood that, right? Because, the startup world in North America and Canada specifically is quite small. And we all have friends in other companies. And we certainly were not the only ones going through this. And my leadership team knew that we weren't the only ones going through this. And so this was a moment for us to really come together. And frankly, I don't know if our team has even worked. We've worked really well together, but that moment was probably one of the most impressive moments for the team, and super proud of how quickly we came together. We found out, and I'll remember this very distinctly, I got that phone call on January 5th, and we had to execute a 150-person layoff on January 17th because every day at that current level, every week that went by was a month of burn at a new headcount base. And so, I think a lot of people can look from the outside and criticize, you had to let all those people go. And yes, that was a terrible thing. I don't think I've been as emotional as I've ever been at work on that day. these are people that, gave their blood, sweat, and tears into the business, and you have to part ways. Obviously a very difficult moment, but the alternative is you don't make that decision, and the people that stayed also don't have a job. You want to have the company continue to survive for the sake of everything that we've went through. And so we made those tough decisions. Cutting the Western Canadian markets was really just a function of their life cycle. At the time, I think Vancouver was less than 16 months old. We had launched Calgary a couple months later than that, so less than a year old there. And then Saskatoon was a market that we'd launched, that we basically got through an acquisition that was earlier in 2023. And so none of these markets had the time to actually mature and get to a point where there was a very clear line of sight to becoming contribution margin positive. Toronto was our core market. Halifax was our first market. And so Halifax was nicely profitable, and Toronto was definitely at that point, very clear line of sight. And we're there now. But the earlier markets, we had just launched them, put a bunch of money into fixed infrastructure, and we were trying to scale it. And then, when your legs get cut out from underneath you, you kind of have no choice. And what I mean by that is capital disappears effectively overnight, and you have to make the tough calls. And that was absolutely the right call for the business in hindsight, and gave us the runway to continue to build.
Yeah, I think also you were saying how the public comps are not helping you. I assume you're referring to Carvana,
yep.
Which obviously lost 90% of its value or whatever.
98%.
98% of its value. And I think also you as a founder were if I don't fight to survive and do these layoffs, there will be nothing to fight for at the end of the day. You were really looking at margin, profitability, things that you knew to look at the whole time, but you could almost kind of put them off a little bit longer as you are growing really fast and entering new markets. But the retrenching from those markets, the decisions were made pretty quickly when you saw the numbers, I assume, right?
Yeah, that was a very obvious, or not obvious, that was a very logical, and I think a lot of these decisions are very logical. I think the harder part is knowing that the decision is the right decision and then having to execute on it, because it's hard. Running the business at effectively, when I was running the business at scale and we're trying to grow really, really quickly, we had, there was you could do it at all costs. We weren't doing it at all costs. We had constraints, but our constraints were don't, break even on gross profit, which means you still were losing money because of your fixed costs and some other variable costs. But that was one constraint. And then maintaining our customer experience and our NPS was the other constraint. So have a really great experience. So don't ruin that as you continue to scale, and don't light the entire house on fire in terms of burning money when it came to selling cars. That was the framework, and that allowed us to grow really, really quickly. But then that is also a framework that requires a lot of capital. And when that capital disappears, you have to change that approach.
Yeah. You said it yourself. The tech community has a ton of great support for these types of decisions. You have other founders who are going through other situations similar that you can lean on. Nobody wants to hear from the VCs of what they have to do, because the VCs are really living in that, day-to-day grind. I get it totally as a VC myself. So for all of our founders out there listening and hearing about sort of the 2 significant layoffs you had to do and the funding rounds falling apart and stuff, are there any insights that you gain from those, hard experiences that other founders should be, aware of and concerned about if they encounter those in the future?
The assumption is that your team's going to leave. You're going to there's going to be morale issues. And I think there was a little bit of that, but I think we used it as a point of galvanization where people came together and we had a very singular focus, and we'd set very specific milestones around gross profit milestones and volume milestones under the new world that everyone was working towards. We hit them when that was for the summer. So we did the layoffs in January, and then we refocused the team around these new metrics for the summer. We hit them. We did a big celebration. We kind of brought everyone together physically in the office to work together. And it felt like we took a bunch of steps back in terms of, going back from a Series B company to maybe a Series A company. Being in the room together, kind of trying to solve these hard problems, has made us stronger as a team. Having that institutional knowledge and frankly, confidence from having gone through that, I think just sets us up for more future success. And I think a lot of founders get nervous about the consequences of making these really drastic changes. I think testament to certainly my team, the resilience and just the motivation and the energy around coming together was really impressive. And so kudos to the entire team there. And I think a lot of people, during that time, at least for me, and I think for a lot of VCs, maybe the answers were super obvious. And even, a year after that initial meeting that I had in New York back in April of 2022, so this is 2023, I was still talking to VCs and getting, narrative of like, I think people still assume they could raise at an up round, right? Or like, the markets haven't, my company's different. We're going to raise more money at, whatever, for whatever reason, people thought their company was different. And I think maybe there's an element of just like, sometimes the writing's just on the wall and you have to read it and execute. I don't think we had any false sense of confidence around, what the market was going to look like over the next year. And so we just made those really tough, but I would say somewhat obvious decisions. My advice is when you see the writing on the wall,
don't ignore it.
Don't ignore it, right? It's like, that's probably the right answer.
Yeah. And also focusing on what you can control, and what you can't control, which is the market, is like just so stupid to focus on. So obviously you adjusted the business model. How is Clutch now adapting the business model in general to the current economic climate? Because you say like the goalposts have changed, and therefore you have to change your strategy to play the game on the field today.
Yeah, I mean, the business model hasn't changed. So we never pivoted the business model. We haven't changed any of that. We're still offering the same value proposition that we were back in 2019, 2020. It's to offer a really great buying experience for consumers. We've added a whole vertical around buying from consumers when it comes to supply acquisition. And that, I think we've done a lot of work around the technology to provide a scaled way to give consumers an instant cash offer for their vehicle. And so we're trying to create liquidity for an asset that historically hasn't had a lot of liquidity, or at least immediate liquidity. If you want to dispose of your vehicle, it's a relatively long, drawn-out process with very little price transparency. And so we're trying to almost create a market for that, where consumers can offload a vehicle in a very quick and easy way. That, I think, has evolved the business, and we've built effectively a machine learning model for each make, model, year of car that allows us to ingest millions of lines of data and then provide a market price for that vehicle really quickly. The fundamental business hasn't changed. We've just focused on efficiency. We've focused on automation. We've focused on investing in the right places. It's amazing what you can do when you focus an organization around a certain goal. And when we're focused around growth, that's what we delivered. When we were focusing on just the foundations and the fundamentals of the business, unit economics, profitability, sustainability, we're delivering that now. And so it's hard to focus on more than one thing at the same time. Everyone's like, we can grow and be really profitable at the same time. Those things usually are hard to do at the same time. My recommendation is always, pick the thing that's most important and try to have the organization singularly focused on that one thing.
Well, I mean, you guys have been talking more publicly about some of these, changes in your business performance over the last year or two. Can you share a little bit more about the impact these changes of focusing have been on Clutch's overall performance?
Yeah, I think we withdrew out of 3 out of 5 markets. Our Q4 was 30%. Even with those markets gone, and only in 2 markets, our overall kind of growth was 30% up year over year. And so despite contracting, we kind of outgrew in our current markets. And so kind of like trying to nail it. Someone gave me the advice early on, nail it before you scale it. And we could talk a little bit about why we didn't perfectly take that advice, but that was part of it. We're offering really great value to consumers and delivering a pricing model that actually works, both for the consumer and for us. And so those things have led us to, very clear line of sight within the next couple of months to profitability. And so we're on a really good path. We've scaled the business. We've continued to scale the business, and then frankly fixed a lot of the unit economics foundational problems that I think this business model got a lot of scrutiny for. We've certainly done that. Others haven't, but we've certainly done that. And then certainly our comp in the US, Carvana, has started to deliver positive cash flow as well. So I think that the market's being validated around this model.
But what's the scrutiny? Because I think like the scrutiny you would say is like inventory and warehousing and logistics and like physical, capital
intensity and cost of marketing. It's kind of just like the whole everything, right? And it's not foreign to me, frankly. Like people were like, food delivery is never going to work. That gets like the economics don't work. And there's a traditional business out there where people buy and sell cars. Amazon went through the same criticism. There's a brick and mortar giant that actually offers a relatively similar service. But once you scale, you can drive cost efficiencies of the business, and you can automate a lot of things, and you can eventually make your gross profit exceed your fixed costs. And at that point, you become profitable.
Yeah. I mean, your founder, Stephen, said that in March 2024, you made almost 115,000 firm offers to Canadians to buy their cars, which is one every 23 seconds, all AI generated. And you paid out over 19 million on those offers, deposited directly into users' bank accounts. So obviously technology is helping you. How is it helping you in other ways, especially, getting a great Canadian-wide brand partnership with the NBA?
Yeah, so I think that's the big piece of it. But internally, we've invested a lot in our internal tooling. Back in the kind of inefficient days, we used to have this very rough metric about number of cards sold per employee. We've effectively quadrupled that over the course of the last year and a half. Really leveraging some of the tools internally. We now track all of our vehicles and how they go through a reconditioning process. We've built sales enablement tools that allow us to more quickly turn deals around, built more automations. We used to actually manually revise every single offer that used to come in when people would try to appraise their vehicle. That's now done automated. And so there's a lot of the internal tooling that people don't see behind the scenes that have allowed us to scale. And frankly, the team, there's certainly a learning curve around this business because of the complexity that, with a couple of years under someone's belt, they've become more efficient. They're familiar with the business and so can innovate. And so a lot of those things, we've had very little turnover in our business, obviously aside from the layoffs. And so we have a lot of institutional knowledge that have stayed with us for the last several years that has provided an immense amount of value because they have an ability to kind of see some of the problems and their experience allows them to creatively provide solutions that allow us to scale.
Speaking of those problems, obviously, when you lay off a lot of people, there's also the concern that customers may also lose trust and access to the company if they had certain relationships in the organization. So how did Clutch, maintain customer trust and the transparency needed during those challenging times? And secondly, were there any insights that you got from customers during those times that helped you reshape or refocus the business in a new way that you wouldn't have without having to actually have those customer conversations?
Through it all, the quality of our product has never changed and the quality of our offering has never changed. And so that's remained consistent. And I think that's what customers really care about. I don't think our average customer reads BetaKit or reads kind of like the technology section of the Globe. Our average consumer is the general public. And so we didn't really have to field a lot of questions or concerns about that. For us, it was a lot of internal stakeholder management and then also with, I would say, the investor community. But outside of that, for us at least, we were fortunate in that I think one, the product spoke for itself. And then two, as long as they were getting that product, some of the tech news that was going on was either not relevant or just not people weren't aware of it.
Gotcha. And speaking of investors, how did investors help or hurt you during those times? And what lessons for even me as a VC did you get to experience that you'd share?
And I've spoken to a bunch of founders that have gone through similar exercises like the one we went through, and where boards and investors have not come to a successful resolution or it got really contentious is when I think emotions and egos started really playing into situations. Our board and our investor community was very at least understanding and accepting of the fact that this was not an us thing, right? Meaning this was the reality that we were all facing. And so in the face of this reality, how do we react? You have a bunch of options. We cannot change the path, and nor can we change what the markets are doing or will be doing. And so given this fact set, here are the options. Choose door A or door B. They have different, or door C, different doors. These different doors have different implications. Let's just pick the right answer and then move forward. That's effectively what we did. We had a really supportive investor base that helped us, bridge to the next round, allowed us to continue to frankly survive and really, live to see another day. Kudos to our investor base because I think there was a lot of conviction there and a lot of just belief around the more long-term view of the business. And so feel fortunate in that regard. I don't think a lot of not all startups had that. And so for us, we got lucky there and that certainly helped us get to where we are today. That's
really great to hear that the board and investor base was so supportive. How are you managing, investor expectations and relationships going forward, looking back on that experience?
Any investor with any relatively sized portfolio will understand, they've had at least, a few companies in their portfolio that have gone through similar situations. If they haven't, then kudos to them. They're doing pretty well. There's certainly a whole degree of empathy there that I think wasn't there in the past because they had to go through it themselves. I think the statistic I saw a couple of days ago that this was a Carta stat that this quarter still startups that are shutting down are still at an all-time high. And so not everyone is through it yet. Going forward, the story hasn't changed at all. I think there's a different approach around how, as a CEO, I'm a different steward of capital than I was in the past because the availability and the cost of capital has changed. And so the approach I take with that capital is very different, meaning, we're not blitzscaling and we're not trying to capture market share. But I think because of the consolidation and rationalization in the market, that pressure is, I don't want to say gone, but it's certainly less than it was before. A lot of what fueled some of that growth mentality was if you're not growing, you're not raising money because your competitor's growing faster than you. If you're not in the markets, they're going to win market share. It's a winner take most market. And so you better grow really quickly because they're going to raise the next round before you are. So let's go. That was the mentality. And so you could look back in hindsight and be like, okay, well, I could have not grown. But then you're like, well, would I have raised that Series B, right? If I hadn't grown, or would I have be in the same position as I am today? And so I think it's really hard to look back and try to reevaluate a lot of these decisions.
You were playing the game that was on the field. And if you play it backwards and say, if I didn't take the money, a competitor takes it and sure outgrows because they're spending money on foolish opportunities. And then you're just distracted while you're trying to optimize. But when the capital is removed from the ecosystem, it's really who's the best at optimizing and building the best value product for the customer base in the market that ends up winning. So it kind of almost takes away that third leg of the stool, if you know what I mean.
I much prefer operating in this environment than the previous environment. I mean, I feel like when I was at Uber, we were also in that previous environment, and it's chaotic. It's fun. It's certainly fun, but it's chaotic. Things break.
And it took them 15 years to get to profitability now?
Yeah. But I mean, my point is, if they hadn't gone through this availability of relatively cheap capital, would they be here? Would they be here in the same way now? I don't know, right? I mean, I think the same would be said about Airbnb or like an Amazon, right? It's slightly different, but I think there's certainly there is a formula that when there is relatively inexpensive capital, it can work if you grow fast enough and build value.
Right, exactly. You are demonstrating the way to do it now and building value, especially with these recent partnerships with the NBA. How is Clutch planning to take advantage of more future opportunities with the advent of AI technology or changing the way that your supply chain works? Give us a sense of what opportunities you see in front of you, maybe without as much capital as you would have taken on prior.
Yeah, we certainly have a little bit of PTSD about making big investments quickly. I think for us, there's a lot can be done through automation just around the customer interaction, providing faster and I would say more accurate responses to customer inquiries. I think the piece of innovation that we're always going to continue to iterate on is our pricing models. There isn't a really great data set and pricing model for used cars in Canada. We're trying to build that best-in-class data set and pricing model for this asset class. And so that's where I think there's going to be continued innovation. Foundationally, it's built on machine learning. And so we're going to continue to ingest data and augment that with additional data that we either buy or acquire through our own inventory, because every day we sell more cars. And so that data is helpful in triangulating the right price for a vehicle. We're still so early in the AI journey. I don't think people fully appreciate how early we are. If you think about the internet back in 2000, I feel like that's where we are with AI right now. And so even fathoming what the next 20 years looks like around this technology is hard. I think it would be hard pressed for people back in 2000 to think about what this thing could do. I don't think really people appreciated that back in 2000. I'm actually really curious to see where this all ends up, and we're certainly starting to make a few strategic bets. But I think there's a lot to come. Yeah,
I mean, it's got to be super exciting with all the data points you have and how much cheaper the technology is available to buy off the shelf, with obviously the frontier models. It's interesting, we still take a lot of the data, especially in the public market on new car sales. And when the big automotive players release their numbers, everyone tries to extrapolate information. You guys can essentially do that for the used car market. When we saw EV sales dropping, and Tesla or whatever, Hertz and Avis unloading their EV inventory. Are you guys getting I guess a head start on a lot of that data that the market is maybe predicting on future growth in the industry or lack of growth?
I don't know if it's necessarily a head start, but we're getting it. And maybe, I mean, I guess you could call it a little bit of a head start in the sense that, we have a pretty robust wholesale business. So any car that doesn't meet a retail standard gets sold in the wholesale markets. And the wholesale markets generally lag the retail markets by 2 to 3 weeks. We do have a little bit of foresight into what we think retail prices will do as a result of our wholesale price visibility. We don't have unique visibility there, but I do think we can process that and then react faster than a lot of our kind of traditional dealership competitors.
Or just general, market ICE engines versus EV and sort of like brands and things like that people are comparing from a repurchase standpoint.
Yeah, we could, and because we have, like I said, we have 115,000 people getting offers every month. We're getting that data, but we're also getting search volume on our site. And so that search volume on our site helps at least it's a proxy for demand. All that data is certainly helpful. And I think that's, certainly the world that car sales is moving towards, is the ability to ingest and process data faster and more accurately than anyone else. And so that's what we're working on.
Yeah, I mean, that was what I was going to ask you. Like, how are you seeing the landscape for the online used car marketplace evolving over the next, 5 years or so?
It's going to be the same as every other consumer category, meaning 10 to 15% of sales will happen online. I think that's most consumer categories. When I first started in 2019, and I asked a bunch of people around the industry, like, what do you think? Will people buy a car online? Everyone was like, absolutely not. But, that was the case.
Telemedicine.
Yeah, telemedicine, but like, engagement rings, shoes, TVs, furniture, right? Like all this stuff eventually gravitates towards a more e-commerce friendly model. And, we've sold, 30,000 cars to people entirely online. And so there's certainly people that want to do it. We have very clear signals around product market fit. When I think about the next 5 to 10 years, we're not going to be that different than a lot of other consumer categories where people are going to discover and transact online. Assuming that it won't is naive, because every category has gone pretty digital at this point.
Yeah, there's a lot of clear, correlations to a lot of industries that are obviously way ahead of, buying such a big purchase like a car. But eventually, you're going to be able to buy an airplane like that, maybe. What advice would you give to entrepreneurs who may be scared to ask for help, or are worried that their situation is so unique that nobody really can have advice or empathy towards what they're going through, similar to what you obviously did, but you had a ton of experience working at Uber before to lean on other thought leaders and operators like yourself?
I mean, in fairness, their situation is probably somewhat, in some way, unique. Every company is different. Every board is different. Every cap table is different. And so there's probably some nuance there that no one can really give you advice on. I think 2023 was probably, early 2023 and late 2022 was probably some of the most stressful times in my professional career. The people implication of what we were doing, the commitment we've made to investors, the operations of the business, all those things culminating kind of around this like very concentrated time period made it incredibly stressful. I have a small network of fellow kind of Series B, Series C founders that, I can just empathize with, and they can empathize with me. And I think that's just like a helpful thing to just know that you're not alone. I really tried hard to remove emotion out of a lot of the decision-making we were doing. Not always an easy thing to do, but particularly when it came to fundraising rounds and taking additional capital and frankly restructuring the cap table a little bit, like those things I think can be very emotional events. There's people that put a lot of money and people put a lot of work into these projects. And so moving that and trying to like really distill it down to like, what are the facts and what are like the core activities that we need to do, at least help clarify things for me. Reach out to a couple of VCs that I trust that were not on my board, that like just, hey, like, is this reasonable? Does this make sense? And I thought that was actually quite helpful. And then, just knowing that you're not alone, and, knowing that like a bunch of other founders were going through this. Like that thought alone just really helped me get through the day-to-day grind.
Yeah, it's amazing to hear that you had that support and that our ecosystem, along with the VCs, can give that support to someone, obviously like you. And it's great to hear that you obviously were able to come out the other side stronger, better, and more efficient. So congrats on all that. Before we wrap things up, we always ask our guests for their fast favorites. For you, the second time. So first off, your favorite podcast.
Actually, I'm more into audiobooks, but I still do my fair share of podcasts. I think Work Life by Adam Grant is a good one. I always tune into All In just because I feel like I have to.
Yeah, absolutely. Next is your favorite newsletter or blog.
Shout out to my friends at Peak. I get it every day, and I feel like it's a nice synopsis.
Still read it every day.
Yeah,
awesome.
It's great. Yeah, it's good.
Next is your favorite tech gadget.
Recently got the Oura Ring. Really like it. Helping track my sleep. Sleep's important. Hard to get it and on a regular basis. Oh, really? Nice. Okay. All right.
I have the Whoop now. So, it's the same thing.
Subscription's more expensive.
Yes, exactly. One thing I didn't actually ask you is what were your thoughts on the Apple car being shut down?
Cars are hard to make. It's a very competitive market with people that have done it a really long time. I'm not surprised. I think Apple could do a better job just building more software. And, frankly, the number one requested feature that people have when they're buying a used vehicle is does it have Apple CarPlay? I think it would shut down with not that much fanfare. And certainly it wasn't really a blip on my kind of like overall radar of things that I'm concerned about. Yeah.
Just shocking, I guess, how big the team and how much money they spent. But for them, it's probably a drop in the bucket. It's what they spend on like cookies in the cafeteria a year.
Yeah. It's kind of like, Facebook's, what's Zuckerberg's thing called?
Meta? Or
not
Meta.
Oculus?
Metaverse?
Not the Oculus, the metaverse thing. Yes.
Next is your favorite new trend.
The lower use of phones in schools and people that are actually focused on kids using less phones, just generally.
Yeah, we're seeing a huge pushback against it. And I'm seeing it too at like dinners and stuff like that. People putting them away and hiding them. But
I think it's a good trend.
A great trend. Next is your favorite book or audiobook that you recently listened to?
Really into like true adventure stories. So Endurance by Alfred Lansing, which is the Ernest Shackleton story. And then, kind of like classic favorite is Into Thin Air by John Krakauer. I just love those expedition, particularly when I was going through those rough times, like thinking about being stranded on a ice flow in the 1900s seemed a lot more challenging than the day-to-day that I was going through. The
life and death of being on the top of Everest versus life and death of getting through a layoff. Yeah, I'm sure it was a lot
Yeah,
easier.
exactly.
And last but not least, your favorite life lesson.
I approach life as the things I do is for the stories. And so, as much as the last few years have been challenging, I've got a hell of a story to tell now. And so I haven't written the last chapter. And so we're still working on that, or the last several chapters. So we've gone through a few of them, and at the end of the day, it's all about learning and it's all about experiences.
Oh, that's awesome. Resilience in the face of adversity. Thanks so much for joining us in the tank today with Dan Park, Clutch CEO.
All right, thanks so much.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcast, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.